All right, let's get the Victor H Investing live stream going. It is August 8th. The market is closed, and we had a really up day today. The NASDAQ closed nicely, 2.87% higher. The S&P closed 2.30 higher, and the Dow was up 1.76. It wasn't like yesterday where the market started on the upside and then through the day just gave up its gains and really went into the negative, which was really disappointing. Overall, the market is just really, it's really had a real mixed result day to day. We started Monday with just a huge drop and it recovered to some extent, but we've had so much volatility this week. This is the 5-day. This is not smooth at all. But today was a very good day. What's encouraging about it is the market came out on the positive. It dipped a bit, and then from there, it just kept its gains. So real solid gains. I think people were in the mood to buy some stocks and hold them. Not a lot of sellers out there. I was expecting it to fade, similar to what it did the day prior when it was up and then it came down. So we'll see what happens tomorrow. I think the way tomorrow goes is going to set up the mood of everybody on Monday. So if we have an update tomorrow, I think we're going to carry that momentum and I guess positive thinking going into next week. If we end, especially if it's a down day, let's say the NASDAQ is down 1% or lower, I think it's going to be, people are going to show up a little grumpy on Monday and probably be a little quicker to sell off stocks and kind of react to negative news. We'll see. I think to this point, the correction is in on the NASDAQ, because if we measure from the top to the bottom where it's gotten, it was down 13% at one point. So the correction is in on the NASDAQ. The S&P, not quite. The S&P is still, I believe it hasn't hit a 10% mark. It's hit 8.5 was the closest, and now it's risen. So the S&P kind of it took some medicine. Some of the prices did come down. NVIDIA's lower than we started a month ago. Amazon's significantly lower than it was a month ago. Meta, I mean, all the bigs, right? The S&P is really influenced by these big cap companies. They all got, taken down a rung or two. So that's good. Mission accomplished. Because my biggest worry as we approached this correction was, these markets, when you haven't, at that point, we were kind of going on this upbeat path. And I'm just thinking to myself, this is great. I love seeing the balances of my portfolio keep going up. But this is really setting us up for a pretty hard fall. And we took some medicine. We took some medicine and took some of that froth off the market. That's good. It makes people realize that, hey, fundamentals and valuations do matter. It's not, make-believe, results or whatever. CEOs tend to say a lot of like ambitious things and investors react to it. Well, hey, that's easy for CEOs to talk big, but really you got to see it in their financials and see real growth. I'm going to highlight a couple of companies who did put up some really good numbers and who have been doing really, really well in the live stream. And I'd love to talk about stocks you want to talk about. So put them in the chat and let's do this. So we talked about the market at large. From earnings releases, we had Eli reporting today. It'd be interesting to take a look at that. That's the most valuable healthcare company really in the world. So we'll take a look at that one. I'd like to look at Vistra, which is a company that I've shorted. It's an energy company. I'll share with you why. And I'd like to look at Catalyst Pharmaceutical. I'm not seeing it on the list because they're a $2 billion market cap. So it's a small cap. Got to show small caps some love. And then go over a couple of others. Like I wanted to go over Uber. They're really on a hot streak. So let's take a look at Uber. And believe it or not, Intel was up today. So I'm going to take some medicine and cover Intel, even though it's the biggest losing stock in my portfolio. Please suggest any other stock you want to take a look at or any other topic you want to take on. All right, so let's start with Catalyst. So Catalyst is, and it is not Catalyst Bancorp, it is Catalyst Pharmaceutical. So Catalyst Pharmaceutical, they started with a remedy for Lemm's disease, and it really worked, and it's really taken off, and that's kind of established the company. And the company is growing really well. They had really positive earnings. They're growing at 20% plus on the top line. They're really establishing themselves as a good pharmaceutical company. And they acquired another company that had a drug near going to market and being commercialized. They launched it successfully, and now they're getting revenues from that drug. That's all good because their financials have been really good. You look at their growth rate. I love seeing green. Look at this kind of growth, 85% in 2023, trailing 12 months growing at 43%. And this is a beauty. It's a small cap. Small caps have not done well. It's a healthcare company. Healthcare companies have not done well. So I think there's a lot of upside potential for a small cap healthcare company. Over the past year, including today, which it had a great day, it's up 28%. But as you can see, it gives investors great opportunities to buy in these low points, right? And I believe in this business, so I've been trying to buy in these low points and get a good acquisition price on Catalyst. Analysts agree that it's a really good stock. It's discounted by 51%. I happen to think that it's discounted by, let me take a look. So I happen to think it's discounted by 42% using today's stock price after that big run up. And I recorded a video. It'll be released in the morning so you can watch the full length evaluation of it. This is just a really solid company. Positive cash flows. I'm going conservative on my cash flow forecast, and it still really values the company well. Their earnings per share are just going to get better from this point. So it's a neat little company that is in a space that I really like. That's Catalyst. So that was a good announcement. They announced last night and carried that into the morning and really rallied today. So congratulations to everybody at Catalyst. Now let's look at the behemoth that is Eli Lilly. So Eli Lilly's really doing well. These guys they're doing a lot of things right. They're up 62%. They had a pullback with everybody else, and it looks like the pullback, it's maybe about 9%, maybe 10%. So that's interesting. And over the last couple of years, these guys have just been on a tear. It's really, they've really put a lot of things together to the positive. They had several drugs that have done really well, including a weight loss drug, a diabetes drug that's really done well. So congratulations to these guys. Even they're a $762 billion company. That's huge. And analysts really like the company. A lot of people like Eli Lilly. I kind of missed on this one. I kind of wish I would have paid a little more attention and understood them better. But thus is life. You can't cover every single stock to the depth that you would like. They've been a nice grower. And you can see that they're not it's not outrageous growth, although the trailing 12 months, they've just really just been lights out, 32% on a huge number already. So, wow, that's great. Good job. And they do provide free cash flow and very good free cash flow. So they've had free cash flow in 2022. Looks like it dipped maybe because they were putting a lot of money into launching the weight loss drugs and so forth. But the market's really rewarding the Eli Lilly stock because a lot of people want to own it. So Eli Lilly, what's the deal with their earnings? So it looks like there's growing demand for their weight loss drugs. that's where the money's at right now with pharmaceuticals. It's both a drug that somebody with diabetes would take, but also people that cosmetically, hey, I want to lose some weight, so they start taking their drugs to lose weight, which is interesting. A little bit like Botox. I know Botox was really popular for people to look better and younger and so forth. So it looks like they did really well in their earnings, and it's just a really good company. I don't know if anybody owns Eli Lilly in the community, but whoever does, congratulations. So let's take a look at VRRM. Looked interesting to me. Put that over here. Hey, Bad Omen, good to see you. Best of. Thanks for joining. And it looks like VRRM. Vera Mobility is a $4.6 billion company. So Vera Mobility Corporation provides smart mobility technology solutions and services in the United States, Australia, Canada, and Europe. It operates through 3 segments: commercial services, government solutions, parking solutions. All right, let me go to their website. Do they have their website here? Because I want to get my head around their business. What do they really do? So making cities smarter. Okay, so they probably install infrastructure. So they're an infrastructure play, and they kind of partner with cities. Okay. All right. And they got government, fleet solutions. All right. Interesting company. Let's take a look at their fundamentals and what are they classified as? It's an industrial infrastructure operations. Got it. 4.6 billion. Their PE ratio is a little high. Looking at their 1 year, they're up 35% over the 5 years. Wow, nice. Very good chart. Up and to the right. So that looks impressive. Their growth has been really good. Although the growth is slowing, it was really doing well. In 21-22, it's begun to slow down. And most recent quarter looks okay, 9.29%. So they are growing. They're growing nicely. They're not breaking any records now. It's single-digit growth. When we look at cash flow, so free cash flow, they are cash flowing, but not a ton of cash flow. So that's interesting. Their cash flow is going down. Let's see what cash flow from operations look like. So operating cash flow is not growing. So they're growing their company, but not their cash flow. That's interesting and concerning at the same time. Why aren't they growing their cash flow if they're getting bigger? They are putting money back in the business, understandably. So I'd really want to get my head around why aren't they growing cash flow? They should be growing the amount of cash they're producing. 142 on a company like this, its infrastructure is growing modestly. I'd want to pay like $3 billion for a stock like this, and it's up to 4.6. So they're doing great, but kind of like this stock has probably had its run. I don't see how they can go even higher unless they really start growing faster. It's a small cap, so that's small caps. This one's been the exception, but small caps haven't been doing great for the last 12 months. So interesting company. It's been a winner for many, but I don't know that it's going to keep rallying. It doesn't have the fundamentals to do so. The analysts say, hey, it's a hold and it's a little overpriced just by 2%. So it's only one analyst though, one opinion. So I guess with my opinion to make it 2, but not a lot of opinions. So this year they're supposed to be profitable, $1.23 per share. It grew substantially from last year, and then it's going to grow modestly in the future years. So yeah, this one is probably something that I wouldn't invest in. The things that I'm concerned about is it's a small cap. It's in industrials, which isn't bad, but if they don't grow substantially, and they're still somewhat of a small company, right? They're still under $1 billion in revenue. I think the gains have already been uh, gotten or have already been achieved in this stock, and not a lot of upside remains. Thanks for bringing it up. All right, Vistra. So Vistra is an interesting company. Vistra does power, and they're a private, to some extent, they're a private electricity operator. So with the whole data center build out and AI infrastructure, I believe that whole play is beginning to lose some of its momentum. Needless to say, over the last month, AI companies have lost significant value, and maybe it's been a wake-up call that, hey, we can't keep talking about AI without it being factual, like show me businesses that are AI. Vistra is supposed to support these big companies that are going to be big AI companies. So they're really marketing themselves as, hey, we're going to power the AI revolution. And that's all great. So all the messages sound super cool. And the company's just rallied big time, 263% over the last 5 years. Look at this chart. This is a utility company. Utility companies are supposed to do this, really not do much from a stock price. So you're like, oh, wow, that's really impressive. They're going to really power the internet, right? Or the AI revolution. Their PE is 58. Forward P is 14. Strong buy by analysts, even though it's only discounted by 11%. And that's after it's really corrected. So over the last month, it's down 14, but it was up a lot today. Their earnings today, I'll have comments on their earnings, which I think I'm on the other side of this trade. So here's what is interesting is, okay, so all these good things are supposed to be happening. So why are you losing revenue? Right? So you have 3 bad quarters. Well, I thought you were powering the AI revolution. What happened? Why is your revenue dropping so much? Now it's come back, but for the trailing 12 months, you're really behind on your numbers. So that's concerning. The free cash flow is not good. Their current quarter, they had negative cash flow, and that's going to be a problem because how can you value a company if they don't have positive cash flows? I can't, so I have a hard time getting to the valuation where they're at. Before the quarter that just ended, that's the quarter that had negative cash flows. They were at 2.2 billion, but now they're guiding that they're going to be closer to 2 billion. Okay, and if I look at that number, evaluate like a utility company, I can barely get to a valuation close to it. But that's with a lot of optimism that they're going to hold that free cash flow number. And utility companies tend to really have to put a lot of money into their operations because they're running electricity producing plants. These things, chew up parts and gears, and they need people to work on them and repair them and do a lot of preventive maintenance and all that good stuff. So the stock was up 6.94%. I reevaluated it, looking at it going, do I really believe that a utility is really going to do this? I'm betting that this stock is going to settle down at like $40 a share, if not 30. So that's why I started to short this stock. And my short position, I'm just up on it by 2% because it rallied a lot today, but I decided to buy more or short more shares today. So I shorted another set of shares and increased my short position on that stock. Right now, I've sold shares that I didn't own that were worth $4,000. And right now, if I wanted to buy those shares back and close the position, it'd be $3,966. That's after this rally. So I'm still up by 2%. At one point, I was up 15% on this stock, but it caught, a rally. And these are all like messages like they signed a contract to provide power to Amazon for one of their data centers. Big deal. It's like, so it's a customer. And then they signed a deal to provide power I think to Microsoft. And it's like, big deal. Like, of course they're going to buy power. They have their data center. They're going to need electricity. That'd be like the local power company saying, hey, look at us. We provide power to Netflix and Meta and so forth. Yeah, they do, because they need power. So I thought it was somewhat silly, but hey, investors bought off on it and the stock's up 7%. This whole space is really upside down, because the best valuation I can give Vistra, and giving them kind of optimistic numbers on their cash forecast as well as their earnings per share forecast, I still see them as 47% sold at a premium. So we'll see how this one plays out. We'll see if the stock goes down and I make money, or if the stock goes up and I lose money. I'll let you guys know. But this one was an interesting stock of the day. So that's Vistra. Let me catch up on some comments. Nighthawk, good to have you. Thanks for tuning in. So AFL. Let's take a look at AFL in a minute. And then let's talk about Carvana Falls Grave. Can you explain why Carvana is up so much? Yeah, let's take a look at it. I've looked at Carvana, and man, Carvana is, if you bought at the right time, I think you could have multiplied your money times 20, but it got pretty darn scary for Carvana stockholders at one point. Let's talk with AFL. Let's start with AFL. So that's Aflac. This is an insurance company. It's a supplemental insurance company that provides a supplemental health insurance plan to employees of companies. I love their commercials. They tend to be funny, and it looks like they operate in the U.S. as well as Japan. Sounds good. Insurance stocks tend to be quite lucrative because they collect all these premiums, and before they provide or pay for services that the policyholders will need, they get to invest the money. They get to earn interest on that money. They get to do a lot with that money. As well as, if they have good actuarians, they make money on the policies themselves. So they make money in a variety of ways. These guys, from a revenue standpoint, it looks like, so you got their premiums. Premiums have not been growing. So they've actually been going down a bit. Interest income has been flat. Total revenue has been flat. If anything, it's gone down a bit, especially in 2022. It went down, but now it's beginning to grow. The most recent quarter did go down a bit, but the first quarter of 24 was very good. So revenue isn't looking great. These companies tend to cash flow really well because they, again, collect premiums, use those premiums. Here's the operating cash flow. It's been coming down. That's interesting. Okay. And free cash flow is good, but it's been coming down. You see how it used to be about $6 billion of cash flow. Now they're down to $3 billion. So why is it 50% lower? So as I go through their financials, more questions come up for me. If I look at their stock chart, man, it's been just going up and to the right. It's almost like the opposite to what their financials are telling me. So I'm not understanding this business. How is it that the revenue's flat? You have declining free cash flows. I don't get it. So why is the stock performing this way? Is there another story out there that I just don't know and should be taken into account? Because the fundamentals to me show that this business is not doing great, not compared to 4 or 5 years ago. 4 or 5 years ago, twice as much free cash flow. The revenue is lower than they were 3-4 years ago. So what's going on? The other factor is, as we look at higher unemployment, which, as we head to a recession or potentially a recession, and people lose jobs, these are going to have, Aflac will have fewer policyholders, because they'll be like, an employer might be, hey, we went from having 10,000 employees to 9,000 employees, so we don't have to pay you for 1,000 employees that we let go, this supplemental insurance. So this one here, I'm not really understanding why their stock is doing so well. I think it would require some homework because I'm not getting it. I have a couple of insurance companies that I've looked at in the past, and this one would have to be looked at a little closely. They are doing well. I mean, for the 1 year, they're up 30%, year to date, up 22%. They're doing great. I just don't get how their financials look bad. What am I missing? So those are my observations on the company. Any comments you have on it? Whoever brought up AFL, do you know why? You're seeing declining revenue, you're seeing declining free cash flow. Why is this stock doing so well? What are the stories out there that are helping the company? All right, let's take a look at Carvana. So I think everybody knows what Carvana does. They're a pretty fun company, right? They're creators of the car vending machine, right? Carvana. So you could buy a used car from Carvana. They'll deliver it to your home. You can also go to one of their locations and they have this, like, I don't know if it's 6-story or 10-story, like, vending machine of cars. It's pretty gimmicky, but it's pretty incredible too. All right. So we know what they do as a business. Their stock price has been, look at that. So they were rocking and rolling during the COVID years. They were at $360 a share. This is when car prices were going through the roof because the car companies couldn't produce as many cars as they would like because COVID, and that really affected the supply chain of parts in order to assemble cars. And that created a big need for used cars. So car prices went through the roof. Carvana really rode that cycle. And then used cars became more plentiful, inventories went up, car prices and values dropped, and their stock, just dropped like a stone. Let me take a look at this one on Google because I like, I'm not spelling right today. So Carvana. All right, so here's Carvana. Let's look at the 5-year from the top to the bottom. They lost 98.69% of their value. Oh, man. That would be hard to take, but it was reality. But then these guys are on the mat. They're like on life support. It's like the ambulance attendee is pumping on their chest, trying to get a pulse because over the last year, up 203%. Woo-hoo. Man, whoever rode this ride must have had a lot of fun. 403% up in really less than a year, starting in November of 23 to this point. You made a lot of money. You multiplied your money that you invested times 3 to this point. So great job if you believed in Carvana, saw that there was a viable business and rode this thing out. It would be rough, even if you were here, right? And you wrote it down, you wouldn't be near getting your money back. You'd still be down 63%. I'm sure most of these stockholders exited the position. All right, so that's who they are. Let's take a look at their business and see what's going on. So now they're a $16 billion business. All right, revenue's 11.67. All right, P's kind of high. Looking at their financials, in 21, you see how they pretty much more than doubled their business. Incredible. They doubled their business, and they didn't really contract all that much after used car prices really dropped. In the quarterly, they're showing growth again. And that's probably why their stock is really going up, is they're showing that, hey, we can really take a punch. They almost went out of business. I think their liquidity became a problem because a lot of their capital and cash is in cars. And when they got kind of caught with a lot of cars in a declining used car market, they had bought a car from, let's say, a person, and they bought it for $20,000, hoping they would take it in, improve it to some extent, do all their quality checks, safety checks, and then sell it for, I don't know, $25,000. Well, they bought it for 20, They put some money into it, and then it was worth 18. Well, you're gonna try to control your losses on that situation. But now I think the car business is really beginning to stabilize to some extent. And these guys really know how to operate within the car business. They're proving it that, hey, they recovered quite well and it's looking good. They are kind of a new generation car company. You do a lot of the business over the internet, which is less expensive. You see a lot of these car retailers, right? The new car dealerships or the used car dealerships that have to lease out these really expensive locations. The real estate's really expensive to lease out. And then they have to hire an army of people to operate this business. And these guys don't have to do that. They do it over the internet, and a person that buys a car on Carvana gets it delivered. They just eliminated so much cost out of that experience for the customer. So that's really innovative. That's really cool. Now, that's cool and everything, but are they making money? So let's take a look. Now, cash flow wise, let's see if they cash flow. Operating cash flow looks positive. And I'm going to stay in the quarterly because this is a story of how they've made a comeback. And we got to study the most recent data that's going to show us the best numbers. And look at that, $332 million of free cash flow. And if we multiplied that times 4, it'd be $1.3 billion. So impressive that they are able to stay alive and make this business work. At that rate, 1.3 billion. Yeah, you can value this company based on their cash flow, 1.3 billion. If they're a growing company, I could give these guys a valuation of 20, 25 billion. So this one's an interesting stock. Let's take a look at their balance sheet to make sure this isn't like their balance sheet isn't full of problems. So they got cash. Again, I want to stay in the quarterly. So they've got cash of 963 million. And let's take a look at the debt. So long-term debt, 4.8 billion. Leases I'm cool with. That means they're leasing some of their facilities. So current portion of long-term debt. So we got to add that. So let's say they have about 5 billion of long-term debt and current portion of long-term debt. So 5 billion. What's their EBITDA? So EBITDA is earnings before interest, taxes, and depreciation. And they do about 1.73 billion. So they're right there at three times EBITDA. So their balance sheet's okay. The balance sheet's okay. All right. So this is an interesting company. I like new generation companies because these guys are growing at the expense of the legacy businesses, like the dealerships that have to spend all this money on a dealer lot and employees and kind of old school legacy cost. Well, they have to pass that on to the customer. Well, the customer's smart. They're like, hey, I can buy a Toyota Camry that's 2 years old from Carvana for $20,000. And I go to a car dealership over here and they want 25. Okay, I'll buy from Carvana because it's a reputable company. I get a good deal. I don't have to pay more money and we're good to go. And I believe they probably sell extended warranties and all that, stuff that the customer's more comfortable because they get a car that's going to be reliable and it's going to be warranted to some extent. So all those things I like about Carvana. So I'm going to take a closer look at Carvana. I might do a video on them because I'm liking what I'm seeing. When I saw them go from here to here, I'm like, yeah, these guys are done. They're done. It's like, how do you come back? Your company was just devalued by like almost 99%. I believe they're having some liquidity issues around this time frame where they're going to be able to operate with the cash they had. So having said that, I'm like so impressed that they hung in there and this management team pulled it off. Now, the founder of Carvana still runs Carvana. I think that makes a big difference because Carvana is like a child, it's so important to this founder. He didn't want this business to fail. He hung in there. He stuck it out And good for him. This is freaking awesome. It's great to see a company get off the mat and say, we're going to be a successful business. Look at the return that you would have had. If you would have bought shares at the end of 2022, you'd be up 3,194%. Boom. Who's NVIDIA? I've never heard of NVIDIA. After, that's what a Carvana investor would probably say that invested in this time. All kidding aside, just that's phenomenal. But I know that I was afraid of the company. I just wrote them off as they're going into bankruptcy. It was cool what they did, but all they are going to be is, if anything, just a footnote of a company that tried to do something special. So really cool company. I'm going to take a closer look. Thanks for bringing that company up. I thought I was going to see kind of like a lot of evidence of a company that continues to fail, but that's not the case. They're doing quite well. All right. So we went over Carvana. Looks like Falls Grave brought that one up. Okay. Do you know like VRTX? So who is VRTX? So Vertex Pharmaceuticals. I believe I have heard of these guys, and they're what I would put in the category of generic pharmaceuticals. But let's take a look. Vertex Pharmaceuticals Incorporated is a biotechnology company engages in developing and commercializing therapies for cystic fibrosis. It markets these drugs. Okay, so it's a pharmaceutical company, healthcare. I think healthcare is a good sector to go into for the remainder of 2024. This company is, let's take a look at their growth. So annual growth looks like it is growing. It's growing nicely, especially in 2020, 2019. They were growing really fast. They've gotten bigger, so they're slowing their growth down. Looking at the quarterly, they continue to grow, even though the growth is slowing, but they're still growing. So that's looking good. And so growth looks good. When we look at their cash flow hopefully is expanding. Free cash flow was expanding. You see how we go from 1.53, 2.54, 3.3, and now it's negative. So what's going on? Something's going on in the current trailing 12 months. Did they have a problem, or are they recapitalizing like a factory? Like, oh, we had to replace a bunch of machinery. That would be something to investigate and understand what happened to the free cash flow. So now we're looking at the quarterly. I want to see if one quarter in particular is the problem quarter. So here's where the cash flow, hit the wall. So here's this. And I think if you go into their financials, they're going to describe, the cash events that happened. And it looks like they acquired another company. That's fine. That's why cash flow. See, but when they acquire a company, it doesn't affect free cash flow. It affects financing. So there's three parts, and let's take a look at their investor page, and I'll take you through their financials, and we can take a look at that together. So, because it is curious to see what's going on. How come? Got back to where I was. Let's try this again. So, VRTX Investor Relations. All right. So what I like about financials that are put together that are GAAP, generally accepted accounting principles, is they have to have the same format. You can't try to be creative with the way that you write. No, you have to structure it the same way. Then guys like me can look at it and say, okay, this is what's going on with this business. All right. So we're going to look at their financials. Let's see here. So this is a quarterly conference call. They should have their financials available by now. So SEC, we want to look at the 10K. So August 2nd, they put it out there. Very good. We got the 10K. Here we're going to see the income statement, the balance sheet, and the statement of cash flows. So we're going to go straight to the statement of cash flows to try to answer the question that I had. All right, so cash flows. So to begin with, they had a net loss. So we're going to go back to the income statement in a bit and understand why was there a net loss. And then once we go from there, this is what I'm describing. All these items will tell you the things that affected operating cash flow. Now, I like to look at the columns and see where there was a difference, right? And there's no big differences between one or the other. Just a bunch of like nickels and dimes that made up a, because we started with a negative 2.49 billion and we ended with 2.44 billion. So it's really in the income statement that we're going to find out what happened. So let's go to the income statement and investigate. Right now we're being, what's that term? Financial investigators, like the CSI Miami guys will do. All right, so here we go. So here we have revenues, and I'm going to go to I guess we'll go to the 3 month and the 6 month. So we have revenues here. Now they're more than last year, so that's good. Cost of sales, here's the number right here. Acquired in process research and development. Okay, so they acquired a company and they're expensing all their R&D. Huh. I've never seen it treated that way. So research and development should be expensed in the current year. So I graduated in accounting. I worked as an accountant with publicly traded companies way back when. But research and development needs to be expensed in the year that you spend the money on it. When you acquire a business, this is I'm going to call it a surprising way that they would treat it if they acquired a business, because it really throws your income statement out of whack. And then it makes people like me feel like this isn't correct. But I guess they acquired a business, and that's what created this really negative event. Now, if they acquired a business and that business is going to create revenue, that's real positive. But how I would have expected for this to come in is that they pay for that business and they put a big portion of this under goodwill and they put it in the balance sheet. And then they amortize that goodwill over time because they acquired a business. Just play along with me for a minute. And that business is going to do 200 million revenue per year. And it's going to grow each year a little bit. So over time, you could say, hey, look, it's generating all this revenue, and I could expense that goodwill caused by the acquisition, and I can amortize it over time. That's the best way to treat it because you're aligning the expense to the revenue that's being produced. But that would be I'm sure that came up in the earnings call. I would listen to the earnings call and say, I'm sure somebody pulled that out and said, whoa, what's this $4.4 billion? Because it's throwing everything else out of whack. So assuming they have a good answer for that, I'm going to go ahead and take that number and remove it from the free cash flow consideration. And for the time being, I'm just going to move forward and say, okay, assuming this number could be explained, and I'm not going to include it in run rate numbers, what I expect the cash forecast to be in the future. I'm going to keep analyzing the company. And when I look at their cash flows, now we're in the financials. And if we take that 4.4 billion that we just talked about and compare it to this number, we're really up about $2 billion in cash from operations. Okay. We're really around the number that they had last year. Okay. That's fine. And if we look at purchases of plant, property, equipment, how much money they had put back in the business, 137. So they're free cash flowing about $2 billion for the first 6 months. So for the year, they're going to cash flow about $4 billion. All right, cool. So if they're going to cash flow $4 billion and they are a $120 billion company, so that's going to be hard to get to that number. because their growth rate isn't very high. It's really hard to get that number. Let me show you an example. Meta's. So why is cash flow so important, right? Is you look at the top 10 most valuable companies, Meta's one of them, and you look at their statement of free cash flows. It's free cash flow, 50 billion. It was 43 billion. It was lower than that in previous years. You see the growth rate in free cash flows. This is why Meta is worth more than $1 trillion. And if you go to Microsoft, they generate even more cash and they show a growth rate on cash. Apple, ditto. Okay. NVIDIA, free cash flow coming out of their ears. So we got, let's call it 50 billion for round numbers. And our friends at Meta are growing their business quite nicely. This is a gigantic business, gigantic. And they grew it by 24%. It's freaking awesome. Incredible. So they're a high growth company, 50 billion times 30 because it's high growth. So I could say 50 times 30 is going to be $1.5 trillion of valuation ballpark. And they're a $1.29 trillion company. So I could kind of say, hey, Meta's in the ballpark of their valuation. I have Meta as being slightly discounted in my valuation that I could show you. But back to Vertex. I can't get to this number because 4 billion and they're not growing that fast. So I can't, like Meta, I can multiply it times 30 and say, well, it's a high growth company. They've shown a consistency growth trend on their free cash flow. These guys haven't showed consistency. They got kind of wacky financials. So it's kind of making me nervous. So the best I could do for these guys is like 60, $80 billion of valuation. And there's a lot of healthcare companies out there that are really discounted. So I'd have to pass on Vertex. It's making me nervous. I don't like their financials. Maybe the market doesn't either. Let's take a look. Market doesn't care about their financials. Look at that. Boom. But over the last month, they're down a bit. Not too bad. Not too bad. They're up 15% year to date, up 34% in 1 year. I'm not overly impressed with Vertex. Today, I showed Catalyst as the first company, right? That company's showing smooth growth, right? Let's go back to Catalyst. So Catalyst is small, but let's see growth. And look at that growth, 43%. Now, these are small numbers, but 43% is 43%. Cash flow. They have free cash flow, and this is a small company, but they've gone from 34, 45, 60, 100. They had an off year here, and now they're back to 160. And if you look at their quarterly, they're probably going to do $240 million of free cash flow. So it's an upward trajectory on free cash flow, upward trajectory on growth of revenue, same industry, healthcare. And I showed that this company is discounted. And, you know, this company is small, so it's probably not known very well. But overall, if you put a ruler across this, you know, jagged chart, it'd be an upward trend. It just is choppy. But hell, I like volatility if you're going to give me a good price. So compared to Vertex, there's other companies in the space that I think would be better investments for me. And that's my opinion on Vertex. So hopefully you found that interesting. So good questions. All right. I got to catch up on, man, we got 24 people in the live stream. You guys are helping me break a personal record. I really appreciate everybody joining. Awesome. Thank you so much. You made my day. All right. So I'm going to catch up some comments. It looks like Limo OO. I don't know how to pronounce your handle. They acquired another company. That's why cash flows are impacted last quarter. I got it. So they acquired it for $5 billion. It's just the way they did the accounting. It just throws off the statements as noted. But maybe that's the way they were supposed to do it. It just makes them look a little strange. I would have to forecast that new business. Is it going to add like how much revenue and how much cash flow? And then if you have that insight, you might be able to buy into a company when investors like me cannot touch it because we don't understand it. You might be able to buy it. And then once it becomes really clear, you are making money and you're in an advantage. But good luck with that. Shadow Guy, not a stock, but XLRE, the real estate part of S&P, has outperformed the S&P in the last month. Yeah, real estate's been kicking butt, and part of it is the lower interest rates really help real estate. And it's a spider, yep. And the reason for it is real estate's such a big asset that most deals involve some type of debt. And if you're going to have lower cost of interest on that debt, it makes the cash flows better. It makes it less expensive to be a property owner. It makes everything better for real estate. So real estate has actually been the number one performing sector of all sectors for the last month. So having a spider and knowing, I mean, if you had either luck or felt like interest rates were really going to drop, which they did, especially last week, they dropped so fast. It was incredible. This would have been a great play. Is real estate going to be good for the next couple of years? I think it will be. It will be better. I have CTRE, which is a REIT. It's doing great. Now, the thing I like about real estate is it's easy to understand. The thing I don't like about real estate is that it has kind of a low ceiling. Real estate investments from a stock perspective, like a REIT, if you study REITs and you study real estate investments from a stock perspective, you're not going to be like Meta where you go up, let's say, like, look at Meta one more time. So if you buy Meta at the right time, you'd be up, and I like these charts, but and I think I could prove it through this company, right? If you buy at the right time, you could be up 1,500%. And if you buy like a CTRE is my stock, I've owned it for a while. It's doing well. Year to date, it's up 22%. In 1 year, it's up 32%. But you're never going to achieve like the Meta-like returns. They're always going to have a low ceiling. So if you're looking for income, if you're looking for maybe a bounce back of real estate, and I think it will bounce back, I think real estate based stocks, REITs, spiders, ETFs based on real estate, it's going to give you income. It's going to give you a bump in value. But I would say that I only have one REIT. And reason for it is I'd rather have companies like Uber, because I believe Uber is worth a lot, and they're going to keep expanding. They're going to keep getting bigger, and they're going to go after other markets that they feel like, hey, we've done ride sharing, food delivery. We're going to do autonomous vehicles for rides where a car shows up with no person behind the wheel. They're going to do other stuff because Uber is going to continue to expand, like Google, like Microsoft did, like, of these like Amazon. Amazon's a great example. Uber is a great company. So I'd rather be in an Uber, and I started buying Uber at the right time and really make just a killing on appreciation of stock compared to a real estate company. This is why I don't like real estate, and I'd rather take my chances on companies like Uber or Airbnb, even though Airbnb is down big, or Meta, or Catalyst Pharma, or United Therapeutics. Those companies can double, triple, quadruple my money, and those are the stocks that I'm seeking and I'm trying to go after. Okay, so good question on the real estate. Interesting time for real estate, but those were my comments. So STRDE Inc. So Neil, good to see you. So let me try to find, do you have a symbol on that, Neil? So ST. I don't think I could find it with that description. STRD Inc. Is it Strides Pharma? Stride Inc.? this is probably the one you were thinking of. So LRN. So Stride technology-based education services. Yeah. So these companies, this one's doing really well. Wow. So market cap 3.4 billion. So Stride technology-based education service company. And let me make sure I'm handling the right one. All right. So hopefully I'm looking at the right one, Neil. I don't see any of the other comments, and I'm running down the right road here. All right. So education and training services. Now, this has been getting hit big. Like if you look at Chegg and other companies, their stocks have been depleted. So why is this one going up? This one's consistently going up. Holy smokes. These guys are doing things right. So they do technology-based education service company engages in the provision of proprietary third-party online curriculum, software systems, education services in the United States. Okay. Got it. And I want to look at their website because I like looking at their website to, just get a glance of what are they doing. So you got, this is a learning company. So they do distance learning software. They're probably selling it to school districts so that they can have a better way of teaching kids online. Got that? All right. Okay, cool. Looks good. And they're in Virginia. All right. So their stock's doing great. Their financials, their growth, we're looking at annual. So why is their growth not really exciting? I get during COVID, they should have got on a rocket ship ride, which they did, because school districts were like, hey, we're going to need, kids to be taught over the internet. Okay, perfect. But then after that, it's kind of just okay growth. Not bad, but not great. All right, so they're growing a little bit. Looks like they're profitable. Okay. Their net income growth is growing. So looks like, they're a software company, and that's why software companies are valuable is they write the software and they can sell it to as many customers as they can and really improve their profitability as they get more customers. So net income has really been growing. Very nice slope on that net income. You see that growth? Very nice. Very nice. So a lot of that cash is ending up at the bottom of the operating cash flow. And CapEx, see how little CapEx they need to put in. Almost nothing. So all that cash is ending up in the hands of the company so they can buy back shares, they can buy other companies, they can do all kinds of stuff. So if they're doing $280 million of free cash, yeah, so I could see how these guys are valued what they're valued. And they've been going up this way because they're so darn small. Their market cap's tiny, 3.4 billion. And they keep growing. They keep getting more profitable. Students are still going to have to be taught. They haven't seen a loss of revenue after, now the kids are, for the most part, back to normal, right? Kids are going into the classroom and stuff. These guys have sustained their revenues. So this one is the second company that I am putting a little star on, Carvana being the other, because I am impressed. I'm impressed by this business. It's a software company in learning. Other learning companies have been getting destroyed, like Chegg, because AI is supposed to completely replace them. Stride is really just doing things right. I'm seeing just great financials, great growth rates. If you have smooth growth rates, you build confidence in your investors, because if you're growing at a particular slope, I'm expecting you're just going to continue on that slope. But if you have these weird financials where up 100 million one year and down 200 million the next year and up 150 the next year, you have no idea what's going to happen next. You're kind of guessing at it. All right, Mike, the dividend investor guy. Yeah, the word I was looking for is forensic accounting. We were forensic accounting a little bit. What's your intrinsic on UBS? Solid company with gigantic free cash flow. All right, so UBS. Let me close this guy out. So UBS Group. So $91 billion company, not the biggest company you've ever seen. They provide financial advice, solutions. Okay, good. I had Prudential, which is similar to these guys, and I made good money on Prudential. Look at this PE. God, 3.26. Am I reading a misprint? That's nuts. All right, what's your stock price been doing? That's a beautiful chart, man. Up and to the right. Up 29%. It's had some volatility. You know, I like volatility. You can buy at these low prices. Okay, good stuff. Dividend is pretty good for that income person that's interested in income. Analysts say it's discounted by 12%. Growth rate. So the revenue grew in 23. Trailing 12 months is doing even better. What's going on over here? Whoa, look at that. That's looking good. So that looks interesting. Okay. So these guys, they're growing in 23. Their quarterly looks even better. They're growing better. In 22, they had no growth. I mean, minus 1% Apple. And other years they were growing. So interesting. Okay. I'm good with that. And cash flow, they're cash flowing. Geez, 48 billion. 48.5 billion. Now, years before they did 31 billion in 23, 22, 21.6 billion in 22. This is where they hit the wall. 35. So this number isn't completely unimaginable, right? You were at 35 in 20, 22, 21.6 in 22, 31.6 in 23. I mean, this is kind of nuts. How is this company generating? So they're generating $48.5 billion of free cash flow, and they have a market cap of 2x that. So in other words, you're buying a business that's going to generate half of that investment, the investment of $91.27 billion. The business is going to return it to you in 1 year. That's like super ridiculous. There's something amazing about this, or needs to be explained. Now, what's also impressive is previous years, they generated huge amounts of free cash flow. Now, financial services is a good place to be because you have declining interest rates. You have, so these guys are a diversified bank, financials, okay. So financial services, I've said before over the last couple months, certain pockets of financial services is going to be a good place to be for the remainder of 2024. This is company number 3 that I'm going to look closely at because that free cash flow is pretty darn amazing. I showed you Meta. Meta was at 50 billion. These guys are near 50 billion. Meta is a $1.2 trillion company. These guys are sub 100 billion in market cap. So it's like, whoa, what's going on over there? And they're probably going to end up doing a special dividend, like a one-timer. And that might be cool because like you buy the stock and then they return 20% of what you invested like that in one payment. You're like, sweet, I just made 20% dividend on a stock. And now, I'm playing with like, I got 20% of my capital back and I'll let the rest ride, So that could happen because what's their balance sheet look like? So how much cash do they have? So cash and cash equivalents. So this is in millions in USD. So this is financial services. So it may get a little weird, a little complicated, I should say, not weird. See, they have loans and stuff. That's what makes it hard to understand. Once you get into banks and stuff, they carry a lot of cash. They have a lot of investments, and it's not like a Meta or a Catalyst Pharma. So I won't be able to really do a cash flow. So this one I'm going to look at closely and take a look at it and see what's what. When you value, this is classified as a bank. And let me show you. You guys have seen this spreadsheet, right? And I did Vistra. Now, I'm about to give you a headache, so look away if you don't want a headache. This is what I have to do to value Citigroup. It's like banks you have to do based on book value, and you have to look at net income growth. It's very involved. You see all these freaking numbers, and this is to get a valuation on a bank-like company or a bank. And UBS, I think, fits into this. I'm going to do that for UBS, but I couldn't do that in front of you guys because it'd take me the next hour and a half, 2 hours. I'd probably give you guys a headache and probably lose everybody on the live stream. But I'm going to look at it and kind of take it through this valuation because that's pretty impressive what they've been doing. All right. Thanks for bringing that up. Let's move on to the next one here. Let me get this off the screen before somebody else gets a headache. All right. So, Mr. 123 Cheetah, can you please look at HOLX? I'm sitting on a decent gain, not sure when to sell off. Yep. Let's take a look. Okay. So what do these guys do? So they develop, manufacture, supplies, diagnostic products, medical imaging systems, surgical products for women's health through early detection and treatment. Okay. So they're medical instruments and supplies in the healthcare space. All right. $19.3 billion company, 68%. So they're up 9% over the 1 year. Recently, they've had a nice rise, 12% in the last month. Very good. Revenue is $4 billion. PE is 28.6. Forward P is 19.2. They've been losing revenue. So they went from 5.6 billion. Now they're at $4 billion company in the last full year. Looks like they're going to complete 24 at the end of September. Trailing 12 months is also trending down. So I like to look at revenue because revenue tells me, is this company's product in demand in the marketplace? Do more customers like the product so they buy more, or they're attracting more customers that like their product or service? When you have declining sales, the opposite. Hey, customers are moving to their competitor. Customers don't like their product. There's more competition entering the market, so there's price pressure. It just signals the wrong things when I'm seeing decreasing revenue. Having said that, so these guys are not growing. They didn't grow 22, 23. In the quarterly, they grew in the most recent quarter just a little bit, but it's good that they're growing. But you see these quarters just red. So red's not good. All right, so cash flow. We're looking at cash flow. They cash flow nicely, although their cash flow was better in 21, 22. It came down in 23. And the trailing 12 months, it's at $1 billion. $1 billion is still very good. The company is, so 19. So I would have a hard time getting to this valuation because they're not growing. If you're not growing, I'm kind of like, well, what do I do here? Are you going to be smaller and smaller and smaller and be less relevant? So I would not be a buyer of this stock. I'd have a hard time getting to 19.3 billion because they're not growing. And I haven't even looked at their balance sheet, but even if you just showed a little bit of growth, I could see that, okay, well, if they could expand their margins, they could be making more money. That's good. But we're seeing depleting revenues, and we're seeing cash flows trend the wrong way. They're going down over time. So I would not be interested in this company. Hopefully you found that interesting. Thanks for asking. Sion Ken. Also, how come a company like Toyota has been between 30 and 20 liability not bankrupt? I don't know, but Toyota is a great company. I'm sure there's a reason. So between 30 trillion and 50 trillion of liability. So when you look at Toyota, you're looking at yen because that would make the numbers look massive because the yen to dollar is very different. Take a look at that. I'm not ready for that question. And maybe on if you bring a question around the balance sheet like that, where we could kind of dissect it on the video conference we do, and I think we're going to do it on Sunday this week. That might be an interesting topic to kind of unravel and talk about for 15 minutes. All right. Lima thanks a lot for the analysis insights. Hey, thanks for tuning in, man. I appreciate it. Thanks for coming by. Mike, the dividend investor guy. I know why ETF dropped, but it really isn't warranted yet. The basis, future of tariffs, China inventory, earnings. Yeah, it could be, like the tariff scare. So here's Elf. It dropped. So there's another beauty company that I think was doing really well today. So Elf Beauty sales jump. So this is the tagline I saw. It jumped 50% on gains in color cosmetics and skincare. So their revenue went up, but their stock price is down. That's weird. So let's take a look at their earnings release, and maybe we can make sense of that, because that's kind of, I expected Elf to be like up substantially. So ELF, Investor Relations. All right, so no, I don't want beauty products. I want financials. All right, so and I didn't want to hit that one. I want to hit this one. Okay, so let's see if they give me sometimes they just give you the earnings in this format here. Here we go. So 50% net sales growth. That's always good. And then cosmetic gain 260 basis points, which is 2.6% market share. Okay. Raises outlook for 2025. And they're in Oakland, California. Okay. Strong start. Looks good. Sales increased. Okay. Net income, solid. EBITDA. Okay. Liquidity. So the company had $109 million of cash and $159 million of long-term debt and finance lease obligations. So seems like a good balance sheet. And their outlook, they have a positive outlook from the previous comments. Okay. All right. So let's get down to the financials. Net sales went up substantially, very profitable, very good. So that's good. Balance sheet, cash looks good. Debt has not been increasing too much. It looks like it increased back here to here, but now it's been dropping. Very good. And then cash flow. So you have 47.5 here. Accounts receivable. Why did it jump up? So accounts receivable means that it went up $31.8 billion because they're owed that much from their customers. So they sold product, they delivered the product, and they're waiting for that money. And they prepaid expenses. Man, that's a lot of money to be prepaying and a lot of money to be waiting on. Interesting. Okay. Accounts payable. So they really didn't cash flow much in that quarter, and they don't have to put much in the business. Historically, the cash flow has been a little up and down. 100 million was their high point in 23. 62 million in, looks like they have a fiscal year that ends March 31st, 2024, which makes sense because retail companies tend to do this. All right, so if we take that number, 62 million, and did we see if they were growing? So, man, they're growing like a rocket ship. Look at that, 76%, 47%, 68%. Okay, growing like a rocket ship. They showed 60 billion, so 60, yeah. The valuation's a little high because their cash flow is 60 million. Even if I multiplied it times 40, you get to 2.4 billion. And man, you'd have to multiply it times like 140 to get to 10.6 billion. So I think constructing this valuation is tough. This is a high growth company. Wow, look at that. This company's really been growing, and now they're dropping 10%. But this one here, I mean, it's going to be hard to value this company because I'm not a cosmetics expert, and I don't have enough insight to say these are the trends that I believe are going to happen. Therefore, this is the kind of growth rate I'm going to apply on this company. I don't have that position. I don't have that knowledge, so I wouldn't be able to do it. So I'd be out. I'd have to tap out. I don't understand it. I have to move on because I don't understand how I can construct this valuation. But it's impressive how fast they're growing. It's impressive that, they are profitable. They're not netting a lot of cash, which is a little bit of a concern. What's their total top line? So they're a $1 billion revenue company, cash flowing 60 million of that. So it's only like 6% free cash flow. I mean, that's pretty good, but man, it's hard to get from, and how many you're paying 10 times sales, which isn't bad. It's a growth company. Yeah, I think the best I could do is say, you'd have to really understand the trends, set up the growth rates that you think are going to happen, and then set up a model that you think is going to be supported. I don't have the right knowledge to help you with that, but it's an interesting company. I appreciate you bringing it up. I would have guessed based on the headline that this thing would be up 10%, not down, but interesting. So a buy for you if it drops tomorrow, man. I hope you make a ton of money on it. Yeah, you're welcome. Thanks for asking your questions. Yeah, I've been working hard this week, man. I've been having a lot of fun, by the way. So last week was incredibly interesting. All the earnings, massive earnings. It was like, holy smokes. It was like the playoffs for NFL football with a lot of good games. Then this week with Monday just being like such a down day, and it's like, what the heck's going on? Very interesting week. So it's been very interesting, and I appreciate you acknowledging it, and I hope you guys have found the videos I've created interesting, and I'm really appreciative of you guys joining the live stream. Got to go. Yeah, there you go. Well, take your wife out to a nice dinner, man. All right. Thanks, Shadow Guy. Thanks for tuning in. I appreciate it. Opinion on AZO. AutoZone. So what's going on with AutoZone? Let's take a look. So they dipped here. I remember seeing them, and I'm like, wow, man, are they a good buy? So AutoZone obviously is based on their growth is going to be on how old cars are getting. Cars are getting pretty old because they're so damn expensive. People are like, hey, I'm going to keep my car longer, and I'm going to have to buy some replacement parts because things are going to break. So AutoZone, I think, is doing fairly well. Over the 1 year, they're up 28%. Year to date, 21%. Over the last month, 11%. Wow, that's really good. They've been growing nicely year over year. That looks good. Revenue, 18 billion, trailing 12 months. That's pretty good. Cash flow. They're cash flowing about $2 billion a year. It is down a little bit. So they grew their cash flow. It's probably because, when you had all those supply chain issues, they were probably raising their prices. Now that supply chains have normalized, they can't gouge customers as much. But they're about a $2 billion free cash flow company growing. So, you can value the company at about 40 billion and they're priced at 53 billion. That's why I don't buy AutoZone. I think a lot of people appreciate it. Companies that people can get their heads around, they tend to have really good valuations, meaning a lot of investors are comfortable and they invest in them. So their stock prices are nice and high. AutoZone being one of them, right? Who hasn't been in an auto parts store, understands the business? But at the end of the day, it's not like a business that's going to be just so dynamic, like an Uber, a Meta, a company that is going to grow dynamically without doing much. They're going to have to open new stores, hire more employees. Their inventory costs a lot of money. There's supply chains to deal with. So it's an investment. If you buy at the right times, you can make money at it. Look at that slope. Very, very good. I can't argue with somebody investing in this because they did well. Every time I value a company like this, it gives me at best just a reasonable rate of return. And I'm like, I'm looking for special rate of return. I'm not looking for reasonable. If I want reasonable, I just buy some bonds. Then I get reasonable and very easy to understand. And that's why I've passed on AutoZone in the past. And it looks like if you bought at the right times, you're making some money because it had some pretty good dips. Hopefully you did, and you made some good money on this stock. So thanks for asking about AutoZone. Saw your video on Robinhood. Who would be a competitor to him? So I think Robinhood, I think if you look at like Moomoo would be a competitor, and anybody like brokerages that didn't exist 15 years ago and really started, operating maybe 10 years ago, that's their competitor. And I wouldn't confuse Robinhood with like Coinbase. They have some overlap, but they really are setting their course in different aspects of the market. Coinbase being crypto 100%, and they're growing in kind of helping institutional investors really manage their cryptocurrencies better. So they're doing interesting things. Robinhood, what I love about Robinhood is that they don't want to be like anybody else, and they really obsess on the customer, and they really are building a company for the new generation of investors. And the generation of investor I am, they built the financial industry for me, but my generation, probably understands the older brokerages, but the next generation grew up with iPhones in their hands, video game console controllers in their hands. They've been playing PC games and been on computers doing their schoolwork their whole life. So when you get them behind a investing platform, they're ready to go. And Robinhood really caters to that type of mentality. Whereas if you look at the Charles Schwabs, they are very like tabular. They're selling to investors that grew up learning on paper, so to speak. So the Robinhood's big competitive advantage is they're always going to be ahead of the traditional brokerages, and they constantly take market share away from them. And they constantly are dominating in the younger investor. Those younger investors are not going to be young forever. A 25-year-old eventually will be a 30-year-old. The 30-year-old will be a 35-year-old. As those investors get older, they make more money. They put more into Robinhood. If you look at their financials, the deposit growth is phenomenal with Robinhood. That's exactly what they're doing. As that young professional, that young investor continues to grow their income, they're putting it in Robinhood, investing it and making money while they're asleep. So the Robinhood business is just part of it is the management team's really smart, but they're really forming a company that is going to be different than the rest and create competitive barriers just in the fact that they got there and did it first and have won over the market share, and their brand is perceived as that's the leading brand in financial services. So I can't think of another competitor to Robinhood, but I would not put them, alongside like a Charles Schwab or that type of traditional brokerage, because it wouldn't be the right comparison. All right. So Neil, $38, $80. All right. So let's see here. Nighthawk. So, hey, thanks for checking AFL earlier. I was curious, any books you would recommend? The book that I read recently was, I'm drawing a blank. Let me get my notebook 1 second. So I want to give you the best book that I read that I thought was really good. Pat Dorsey, The Little Book on Investing. That's the best book I've read in the last 10 years on investing. I read the book before that was on top of the list was Peter Lynch, and One Up on Wall Street. I really liked his book because I liked how he really told the investor that, hey, you can be a great investor. You just need to invest in areas where you have advantages. I love that concept because it's true. There's 100 different industries. No one person's a great, at every industry. So that was great advice. But this one, Pat Dorsey, excellent book. The guy was Morningstar, mutual fund manager of the year repeatedly. He was a great investor. And the way he lays out his book, excellent. Every part of the book, excellent. So that's the best book on top of my list. All right, so Shadow Guy. We covered UBS before. Yeah, so I'm going to look at it more closely. We'll see how that sorts itself out. So I'm buying Nike. I think Nike is the most dominant athletic footwear on the planet. They have advantages against their competition. They're having a bad year, and their management team is kind of being questioned. And it's just a bad cycle. I think in 2 years, people are going to be looking at a stock that's worth 30 to 40% more, and it's going to continue to be that way. They're going to be, a dominant player like Alphabet, Microsoft, Amazon within athletic footwear. Now with the Olympics going on, I'm sure they're going to get a bump in sales due to the Olympics. All right, so let's keep rolling. And we're coming up on 2 hours, so I'm going to try to find a good landing spot, and then we'll move. So the lost revenue for HOLX was COVID related. They had a bumper COVID. Oh, okay, very good to know. Very good to know. All right, so all right. To Tommy, man, thanks for checking in. Any chance input on GLID? GILD, Gilead Sciences. So they had kind of a flat day. I think they announced today, and I don't know a ton about Gilead. Looking at their chart, it may be an opportunity. There's a lot of opportunity in healthcare. If you look at the statistics, healthcare didn't do so well over the last 2 years, but these are great companies that have patents on drugs and remedies and treatments for people that have illnesses. And when they need them, the insurances pay for that treatment. So this would be worth taking a look at. At a glance, I think, the analysts say that it's a buy, but it has a small discount. $94 billion company. And I'll do a quick glance at their free cash flow. I mean, they're cash flowing last full year. These guys would value above this number. If the business is on the right path, if their business is beginning to grow, looks like they've had it. Yeah, this one would be interesting. This one would probably value well. I'm going to look at it a little closer. I do have a couple of investments in healthcare already, so I wouldn't be very, very eager to buy one more. But if this one replaces one of the horses that I'm currently invested in, I might be a buyer. This one does look good, kind of high level. I would give you that comment. Falls Grave. So do I think Rivian's going to make it? I think they are. And the reason for it is first, Amazon's one of their big investors. Ford got out of their investment in Rivian. And if in Southern California, you see Rivian electric powered, delivery vans everywhere. So I think that business is really a majority of their revenue. And that's going to be very stable, which is a really good idea to have these electric powered delivery vans. So I think that's the part of the business that's always going to be really good. They're high end, very expensive automobile sales. Automotive is just always so damn tough. I'm not eager to buy another automotive company. I am losing my shirt on Ford, and I'm not ready to buy into another automotive company. If it's automotive, I want nothing to do with it for now. Neil, so you're from Wales. Cool. I could argue that auto parts stores would decline as EVs become more popular. You could argue that. Yeah, you make a good point that EVs are supposed to have fewer parts and don't break down as much. It's just going to take a while for EVs to really be a majority of the marketplace. That's one more reason that I'd be concerned about that business. So you bring up a good point. Robinhood was giving 3% if you transferred your IRA. Available for a big chunk. See, this is the kind of stuff they do. They're not afraid to kind of break molds and step outside the line, color outside the lines. And that's what you need, man. You need people to be creative. I'm not asking them to do anything illegal, but you're right. Like certain things in financial services, like banking sometimes drives me nuts. It's like, why does it take so long to do things? And why have you been doing the same thing for 50 years? Every other industry is like really advanced how we do things quicker, faster, less expensively, more conveniently. And banks don't do that as well. So you bring up a good point there on how Robinhood is really advancing their business. Yeah, thanks for bringing it up. I'm going to look at it closely. I appreciate the suggestion. I come out of these live streams and have a list of stocks that I'm going to go into a little further. And sometimes I get a nice diamond in the rough. So till the end, have I checked RKLB? RKLB. Rocket Lab. What the heck do these guys do? So Rocket Lab, space company, provides launch services. Okay, so I think I've looked at these guys, and so they started revenue. Okay, they have revenue. They're losing money. Okay. And cash flow. So you see how they have negative cash flow and they have substantial negative cash flow. So when I looked at it, these are not the investments that I'm eager to get into. I'm not a rocket scientist. I don't know much about rockets, so I'm out. Now, if it was an industry where I have a lot of insight and I'm like, hey, this company, I believe they're providing something that is huge demand. And yeah, they're losing money, but I want to be a part of this thing, maybe, but that's not the case here. They're losing money. They're burning cash. If you have some insight on their business and believe that, hey, these guys are going to take 50% market share of rocket launches, more power to you. You have an advantage there, and I would take it. So that's my opinion on that company. All right, so I'm going to have to move. I'm sorry I can't cover these, but maybe on the next one. I really appreciate you guys tuning in. This was probably the highest attended live stream. We went an hour and 34 minutes. It was a very, very good live stream. I got my fingers crossed that tomorrow we have a positive open. Let me take a peek and see what the gods of the stock market are saying so far. Well, I don't know that this is correct. Let's see if this one gives me any kind of sense of the futures market. So pre-market is flat. I'm hoping that we don't have a pullback tomorrow because this week's just been kind of a rough week, man, with volatility. You have down days, up days. and the stock market just going up and down. It looks like a wood saw right now. So we'll see what happens tomorrow. My fingers are crossed that it's an update, because then it'll kind of set the mood for next week to be a positive week. But if we have a down day, I think we're going to have somewhat of a repeat of this week, which is going to be really interesting, but it may lead to additional losses to our portfolios. So let's tune in tomorrow. Everybody have a good night. Thanks for attending. Good luck with your investments.